Um, there we go. Thank you. Well, for those of you that don't know me, I'm Leslie Feinzig. I'm the founder and managing director of Graham and Walker and Graham and Walker Venture Fund. And this is our first event of 2022. And it's the end of January, and what a long January it has been. So here's hoping that you're all healthy and have had a less chaotic month than I have. I'm very excited to share content with our community that is focused on activating the potential of all women in business. That's kind of our expanded thought. And that's this idea that, when we started Graham and Walker, formerly Female Founders Alliance, it was really about activating the success of women-founded companies. But what we realized is that our ecosystem is a lot bigger than that. And it takes all of us participating in every part of it in order for us to make a meaningful change in what the highest levels of the economy look like. And so really, really excited to help you all become angel investors, or at least learn about it, kind of try on the hat and see if it's for you, and do so in a very inclusive, safe, collaborative, community-driven environment. Let's see. So today is a roundtable. We host these several times a year. These are sessions where we bring in specific experts in areas where they share their knowledge with the community. And our goal is for this to have as much discussion as possible. But we have a long presentation that Elaine is going to walk us through. So what I'm going to ask is, whatever questions you have, please put them in the chat. We're going to keep kind of reading through them. Divya and I are going to kind of guide those questions to Elaine as she is going through. And as I said, we're recording this session, so we're going to share the recording afterwards. So if there's something that you feel like you missed, you can always kind of come back to it and learn about it. Now, today we are joined by my friend and actually my investor. Elaine is an LP in my fund, Elaine Werffeli. Elaine is a 25-year veteran of Microsoft. She is a co-founder of 2 startups, and she's an active angel investor in the Seattle area. Within the angel community, Elaine can be found participating in due diligence, funding, advising founders, judging pitching competitions, presenting insights that reveal the latest trends benefiting both investors and founders, which she is going to share with you all today. And she is passionate about strengthening the angel investor ecosystem by encouraging more women to participate. I have learned about angel investing and VC investing from Elaine through the many years that I have heard her do these presentations in different places. I feel extremely lucky to count her as my investor, and also as a friend and somebody that I can learn from. And I'm very, very excited to be able to share that opportunity with you all today, to have Elaine talk to us with folks from outside of Seattle who maybe have not had an opportunity to learn about angel investing. So with that, Elaine, handing it over to you. I made it through the intro without my computer imploding, which is it's a big win for me today.
That's a great opportunity. Leslie, thank you so much for that wonderful intro. And team, I'm so excited to be here with you. As Leslie said, I've kind of sat on both sides of the table. And what I want to do is, hopefully my goal today is, whether you are interested in angel investing, an angel investor already, or a startup entrepreneur, I hope to leave you at the end of this presentation with a couple of tidbits that you didn't know before that help you on your journey. So to give you a little bit just about me, so you know where I'm coming from my angel investor journey. I first had to learn that I was an accredited investor, because I really didn't know what that was. So once I found out that I was an accredited investor, I found and joined an angel group that I could learn from, because there is a beauty of learning in a group. I have been active with an angel group and investing for over the last 6 years, and on my own. I have a portfolio of over 20 startup investments, and we'll talk about why I think that's super important. I have seen positive results and progress from the startups that I've invested in, and I'm super excited to share all of those learnings with you today. So what we're going to talk about and focus on is the 5 W's and the H about angel investing: who, what, why, when, where, and how. So if we let's start with the who, so you guys can also understand some of those fundamentals that I started off on my journey is. So who are angel investors? So angel investors are what we call individual accredited investors. And what's key about that is that these angel investors provide their own financing with their own money. And when we think about where does that investment go, it goes usually in early stage startups. So in that ecosystem, angels kind of start things on their way. And that's either usually in exchange for convertible debt or ownership equity, so that you are then a partner kind of along for the ride in those startups. So when we think about what is the definition of an accredited investor, well, you can become an accredited investor in 3 main ways. One, your annual income, and you can qualify either as an individual or with your spouse based on your gross income. The second way, and so in that specifically, $200K for an individual for the last 2 years, and future looking 300 split with a spouse. Net worth is the second way, and there you can do it as an individual or married couple with a net worth over $1 million, excluding your primary residence. And then as a trust manager, you can get in with also more than 5 million in assets. But usually it's those first 2 that are allowing you to be an accredited investor. And the reason that people need to be accredited is because this is a riskier space to invest in than others, right? But one of the things that's really important for us to know is that there are so many angels who haven't gotten their wings yet out there. When we think about the people who have 1 or 2 of those ways, there's a whole lot of people out there, and today's active angel investors are only capturing maybe 3 to 6% of that. So it's incumbent on people like myself to spread the word so that people can become more knowledgeable that this is a way to participate in the ecosystem today. I'm super excited to be able to share that the percentage of angel women investors has grown over time, and we are now close to 30% of all angels in the US are women. So you can see that that's grown over time. Again, I'm a proponent of having that number continue to increase. I think the diversity of investors sitting at the table allows us to have a diversity of ideas that get funded and move forward. And when we think about the importance of angels in the ecosystem, I wanted to just throw up this slide. This green bar here shows us the number of angel and seed deals that come from angels. This blue bar is from late VC, and the orange bar is from early VC. So what you see across time from 2015 to 2001, this information is from PitchBook, that the angel deals are really more numerous in numbers and catalysts for this environment we're talking about. So we as angel investors play a super important role in kicking off the process. And when we think about angels versus VCs, there are a couple really important distinctions, and just want to kind of clarify that. So we understand, even as entrepreneurs, the role that angels play, and then there is like a pass off to kind of VCs. So with angels, angels invest their own money, while VCs are investing other people's money. The check size is usually different, because with angels, since they're investing their own money, it's usually smaller individual checks. Whereas with VCs, because they have much more money to deploy, those checks are larger, but there's, as we saw in that previous slide, there's less of them. When we think about stage, angels invest in that timeline earlier, and VCs on average their money goes to later stages that have proven themselves a little bit more and hit certain milestones. What we have seen lately, though, is VCs kind of moving down into that top of the angel space to be able to get in earlier in some of those deals, which again is great to see, because there's so many exciting deals to fund and make sure that they can get to the next stage. In terms of outcome, those are also pretty different. VCs are usually looking for some of those larger IPOs, unicorn potential, whereas angels, man, I'd certainly love that. I'm not saying that that's not a super ideal, but in terms of what's more likely is that there is a sweet spot for acquisitions that happen earlier than that. So there are differences in those pieces. When we think about the when, I've kind of kicked off that timeline, and this is the capital lifecycle. And so when we think about entrepreneurs, startups, starting with their early stage, self-funded, small amount of money, that next kind of phase when is in that feasibility stage, they can look for friends and family money, pre-seed. Then angels kind of kick in that seed startup area when we're looking for money from anywhere between like 25K and that $1.5 million kind of raise that we're talking about. So individual versus total checks. And then that's where we start to pass off to seed stage VCs, venture capital in Series A, Series B, Series C, and on as a startup begins to scale and hit maturity. So this is just a great way to kind of put everything in perspective, and when that kind of money kicks in and what comes before and what comes after. So if we talk about the how do angels invest? And you know, really, angel investors aren't all in one same bucket. So it's interesting to think about how, if you're an entrepreneur, how your fit is going to be with an angel or an angel group. And as an angel, it's from your perspective, thinking about how is it that you're looking to invest? Do you want to look and invest as an individual, or do you want to invest with groups that would be angel groups? And when we think about it, if we're thinking about the angel perspective, there are two main types of angel groups. Networks, where there's pitch first, and then you can fund as an individual choice, or funds where you fund first. And there's different ways to think about the funds. And so when we think about that, there are active funds, passive funds, managed funds, and event funds. So as an angel, you probably want to start thinking about how involved do you want to be in the process? Because in an active fund, you as a member are rolling up your sleeves, figuring out screening, deal flow, due diligence. If it's more passive, then there are others that we're relying on algorithms, or you are seeding those decisions to someone or something else. In a managed fund, there are general partners that kind of make those decisions. And in an event fund, like the angel group that I'm in for SAC, we write our checks before we do research and diligence, but we don't know who is going to win until the big check at the end. So lots of different ways to get involved, and whatever is comfortable and interesting for you. So when we think of the what is it that angel investors do? If we kind of try and want to boil it down, there's a lot that goes into it. But in that process of investing, meeting with a large number of startups and founders, reviewing their pitches, getting to know them, in this process, it's kind of this larger process of doing due diligence, that the due diligence is to understand whether as angels, we're going to invest our own money or not. And when we think about due diligence is kind of that investigation into a potential investment to confirm those facts or assumptions. So we've seen pitches, but we've leaned in a little bit more and want to understand and peel the onion, the different layers, to start to understand the founder, the team, the problem that the startup is facing, the solution that they're delivering, that market size, market growth, traction to this point, and traction that we think is going to be achieved moving forward, competition, you go to market strategy, financial model, potential exits, the ask and use of funds, right? All of those we dive into the due diligence process. And I would say when we think about it, probably I've heard numbers to might have 40 different companies that some might have coffee with or review before an angel gets down to writing that one check. So just so you understand how that kind of process of going through the funnel is a time-consuming process. And for me, that's one of the reasons I join a group, because it's not my full-time job. So it's great to be able to do that and count on the expertise of others to do due diligence together. And another reason why I join a group is because there's not a whole lot of research in the angel investment space, but there are a couple points. And one of those is that you can improve the outcomes in your portfolio by spending a significant amount of time doing due diligence. So what this kind of graph shows is that the outcome of your portfolio improves if you have the impact of time to due diligence. So I would say a median is 20 hours per potential investment opportunity. With some groups that's more and some groups that's less. But on average, just so you have kind of a yardstick of what is kind of that minimum bar that you should be shooting for to be able to, if you're active within there, to give your portfolio that boost that it needs to have the kind of returns that you're looking for as an investor. And when we think about how, this is another one of those charts that there's a lot going on the page, but what this really tells us, the first column is, this is if I put money in, what is my multiple or X return from that money? So what this graph shows us is that ideally I'd want to be on the right side. I want to increase my return. And the question is, how long do I have to hold my money for an increased return? And how many of my portfolio or options actually have a large return? So the largest percentage of return of companies that you invest in aren't going to give you a 5x or 10x or 3x return. The largest number of them are not going to give you a return. So when we think about that, that's why it's very important to do the due diligence process so that you can become smarter about who you would share your money with. And then the other principle that I'd like to say that is really important is creating a portfolio. So like anything else, you want to spread the risk around. And the reason why you have to be an accredited investor, as I said up front, is because angel investing is risky. More startups fail than make it every year. And so if that is part of your investment strategy, you only want to take a portion of the dollars that you invest to invest in angel investing and as the startup ecosystem. And you can make it larger or smaller depending on your risk tolerance, but a typical guideline might be between 5 to 10% of that net worth. So if your net worth is 500K, that would mean in your portfolio, your total amount that you would set aside for angel investing would be like 50K. If you had $1 million of net worth, that would mean that 100K of your portfolio you would set aside to write checks to help startups along their way. And when we think about what does that translate into to investments, it means that you have the ability to write checks and should write checks over a number of companies. So if we take that example of the 100K amount that you would want to set aside for your angel investments, what the kind of rule of thumb is that because there is this diversity of startups, that how we look at those that can give a return and then how much of the return they have, whether that be a 3x or 5x or 10x or more. In order to be able to end up ahead, you probably need a minimum of 20 investments in your portfolio. And right now, sometimes some of the things I'm hearing is actually between 20 and 40. So if you want to get in to 20 and 40 investments, to me, one of the ways to do that is to join a group, because that's easier to be able to share the time and share the expertise in vetting and deal flow. But the other thing to know is, what is that check size in order to create a portfolio of 20 plus investments? And that check size would be 5K. And so usually individual angel investors writing a check, probably outside of a group, that beginning check size might be about 25K. So in first starting out, also to get to your portfolio with a check size that helps you spread that risk, it's another reason that a group might be a good way for you. And yes, you can get into angel investing in a check size as small as 5K. And that's one of the great ways to unlock and start to stick your toe in the water of angel investing to make sure that that's something that's right for you. And so not only can you diversify your portfolio across a number of investments, and that is a really important way to diversify, but you can also take different dimensions to diversify by stage of startup that you're investing in. So whether that be early idea, or whether that be pre-seed or seed or Series A, right? You can kind of invest along that spectrum of how mature the company is. You can also invest in the spectrum of industry or founder diversity. And we're going to close today with a slide where Leslie can pop back on and talk about the Graham and Walker Accelerator and an opportunity to invest in some fantastic female-led businesses in the accelerator coming up. So lots of different ways to diversify. So now when we think about that where for angel investing, I wanted to share with you some of the latest trends from the Halo report. So this Halo report is for 2020, the 2020 year of investing. It's a combination of the Angel Resource Institute and PitchBook who put this together based on over 2,000 deals. So you'll find out I'm like a total data gal, data geek. And I do this every year because I think it's great for people to have the insight of knowledge and learning about the deals that have been done and what we can learn from that. And so when we think about different regions, that's why I kind of said in the beginning of the presentation, where are you coming from? So you can kind of be grounded in the different regions where you are and kind of see where they stack up. So when we think about from where are dollars coming from into this startup ecosystem, California angel groups are responsible for more than a quarter of all of those dollars invested. And you can kind of see as we go through, the next nearest region is less than half of that. And one of the other things that's important to know is how much angel group investing dollars stay in that region. So that when you're on the angel side, that you know kind of what are your peers doing, and as well as if you're a startup entrepreneur, you can understand how much to rely on your region to fill your round versus how much you're going to actually have to go out of your region to be able to fund your full round. And here in the Pacific Northwest, we're very homegrown, where we're the largest at 90% of the funds that we do are stay in the region. And that varies all the way through the regions to New York, where the majority of the New York angels go outside the region. So, and everything in between. So great to know where your region stacks up against those norms. And then if your angel group is investing outside of the region and those angel funds, where do they go to? And so you can see that both California and the Southeast are the two of the top, whether we look at on the left by percent of deals or the right by dollars, where those funds are going to. And then if we think about the angel, the startups themselves, this is the percentage of where the startups are located. So we see the largest again in California at 21%, all the way down to that smallest percent of 4% of the startups that were funded in 2020 came from the Great Plains. So there is definitely a difference in terms of the number, in terms of regions of where we would expect startups to come and pitch us from. Also, when we talk about diversity and industry by sector, I wanted to just share with you that there's definitely different industries and different percentages that angel groups are investing in, with information technology coming out on top, but followed closely behind by B2C, healthcare, bio, B2B, and then small investment percentages in finance, energy, environment, and materials. This is another way to diversify by that industry. Another thing that comes up often in terms of evaluating deals and kind of closing deals is valuations. And so I wanted to share with you pre-money seed and Series A valuations. And here the national average is 6 million for a median and 8.5 for the average. And on these slides, I want, it's important, I feel, to present both the median and the average. And the median is, just as a reminder, is if you stacked up all of them, largest to smallest, and you walked in from the ends, what would be that center one? And the average is if you summed all of them and divided by the number that you have. And I put that in because averages can be skewed by deals on either the high side, mostly on the high side. So in this case, you can see that the national average is higher than the median, meaning that there are a number of very large deals in the seed round that are skewing that number. So by looking at both the median at 6 and the average at 8.5, you're a little bit more knowledgeable about that range and what you might see in your region. And you can see the medians across region are fairly similar and vary less than the averages. So again, just want to make sure you have that information as you're thinking about deals that you see coming through in your deal flow, or as entrepreneurs, how you're valuing your companies, so you have a yardstick of knowing how that stacks up with others in your region and across the country. If the company is a little bit larger and out raising Series A funds, this is the trend that we actually saw in the last 3 years here, where there was significant growth in both the median and the averages from 2019 to 2020, 32% on the medians and 22% on averages. So quite large numbers growing here, where our medians at 14 pre-money valuation and the average at 22. So again, just want to make sure you have those numbers to reference. One of the things that was pretty surprising to me this round, and I think that popped in the numbers from 2020 that I wanted to make sure you were able to take away, is that in both the seed and Series A funding in 2020, the asks were higher than how the round was filled or ended up. So in the median for a national average, the ask was $1 million for seed rounds, and the final close was half that at $500K. The average, again, skewing higher, average asking for around 1.9 million, average close at 1.6. So neither closed at what the round was kind of requesting, average closing at a higher percentage than median. And when we look at the Series A, we see a much smaller percentage of the asking funds being closed upon. So asking for a Series A median at 4 million, and the median obtained was 400K. And you can see that it's quite lower, but our average is much higher than that at 2.7 million, but an average ask of 6 million. So from both sides, knowing that rounds did not, on average, did not fill is important to know from both sides of the table moving forward. It'll be interesting to see what we see in 2021. As soon as those numbers come out, I'll be happy to share them with you. And then I love to kind of share this view of knowing more about the who across regions. So what we have on the left is the percent of female CEOs across the region. So if we had 100%, how does that split up between the regions? We'd find 26% of female CEOs in California, 4% of female CEOs in the Great Plains, and the rest are spread out, as you can see within those groups. But it's really kind of also important to know within each region, what is that percent of female CEOs that we'll find? And that's what we see on the right. So as the national average, female CEOs that were funded in 2020 was 16%. And when we looked at within each region, New York has 22% of those startups that were funded were female-led. Great Lakes at 10%, and a full range of difference in between. And for the first time, super excited to be able to be sharing also minority CEO numbers. Where on the left, California is by far having the largest percentage of minority run and funded in 2020 at 29%. And when we look at within each region, California, Mid-Atlantic, New York, places where minority CEOs were popping high above the national average of 12%. So great stats to know and follow there. This is something that I think on both sides of the table, entrepreneurs and angels can sometimes forget, and is good to make sure we have in the conversation. So all that way on the right, it's about 70-30 split in terms of funding, and funding meaning in the year of 2020, the checks that were written, 70% of those dollars went to new companies, 30% of those dollars went to follow-on, meaning companies in which they had invested before. So if you're a new company looking for funding, know that the pocketbook solely doesn't go to new companies. If you are a company that's been funded before, super, super important to know. It's really, really important that you keep your current investors up to date on what's going well, what's not going well, asks, because when it comes time for you for your next round, they are the investors that you want to get money from first. And they are ones that are setting aside money for that purpose. So those conversations are something to know from both sides, and make sure that along the way we're preparing for those conversations. And then lastly, on the region information, wanted to share with you that convertible notes continue to be the favored way that funding is seen across the different regions. The national average, 54% of those deals in 2020 were funded with convertible notes, 30% by preferred equity, 10% common stock, and only 6% with safes. We hear a lot about safes sometimes, but when you see the deals and where they ended up, they're not as prevalent as the other forms of funding. And so to kind of close with the whys, because I think this is a super important part of the conversation that we want to have. And this is an important part for me. So when we look at the growth rate of female angels, it's been significantly higher than non-female angel investors. So this is the trajectory on the right in green, up and to the right, growth year over year in terms of that trend that we're seeing. Well, what I find super interesting is if you look at women-owned businesses, this is now the chart on the right. So this chart on the right is percent of entrepreneurs seeking funding that are women-owned businesses. And so we can see that goes up and to the right. The percent of angel investors who are women on the left, up and to the right. And so when I think about how this positive cycle feeds upon itself, angels fund entrepreneurs, 55% of angels were former CEOs of their own startup. So entrepreneurs become angels, angels fund entrepreneurs. It's this fantastic positive cycle of growth, scaling, and expansion in the ecosystem, and love to see that in a more diverse way. And that honestly gets me super excited. So when I wanted to share with you reasons that angels invest, first and foremost, it is for financial return. It's not philanthropy. That is something different. And angels are investing to get a good return in their portfolio. However, that's not the only reason. So we're seeing a diversification in the wealth. It's to help job growth in the local economy. Having a front seat on the latest innovation trends is pretty cool. Meeting and working with like-minded colleagues who become your friends is another great growth reason. Personal growth and learning by learning something new. It's definitely a way to give back, to leverage the expertise you have. I am surprised over and over again as new angels come who really undervalue what they can bring to the party. And startups always have gaps. No startup is complete. And advising and mentoring startups, you have more to offer than you realize. And in addition, sharing the learnings of what you have with new angels to help bring that ecosystem up is wonderful. It's really quite a high energy activity, it bringing personal happiness, fun, and it does make a difference. So I'm super excited and supportive and looking forward to talking with you all in the last couple of minutes of questions that you have. And how you can become part of this ecosystem journey. I wanted to share with you some kind of getting started materials, places that you can think about and look for deals. In terms of, there are women-only angel groups out there. Pipeline Angels, Golden Seeds are a few of them. If that is the way that you're interested in going. I did mention Seattle Angel Conference is one of the angel groups that I'm involved in. There's a great book by David Rose on angel investing. And right here, Graham and Walker has a fantastic accelerator and a super cool opportunity that Leslie's just going to quickly wrap up and talk about that's coming up next month. So Leslie,
sure, I wasn't sure. Is that my cue?
There you go.
Yeah, so I know that we're going to do a bunch of Q&A, so I'm going to keep this part short. We run an accelerator. It's on cohort 4. Ready, Set, Raise is a national virtual industry agnostic accelerator for women and non-binary founders. Cohort 4 has 6 companies in it. They were selected from something like 400 to 500 applicants. I think that they, are they on TechCrunch yet, Divya? Or like,
I'm still watching.
Really awaiting for the batch to be announced in like mainstream tech media. I think that they're on Keycar already. So anyways, yeah. Today was a big unveiling of, it's coincidental to this session. It wasn't on purpose, but look how it turned out. Anyhow, the 6 companies are all tech companies. They're across a variety of different spaces. And we, we run this accelerator to help these companies prepare to raise their first pre-seed round, and in some cases, their seed round. And what that means is that we put them in front of hundreds of different investors. We will be previewing or opening their rounds at the end of February, which means that all of you, if you'd like to try to kind of come in and take a look at some companies and possibly make your first investment, or have like a shared pitch environment where you can like listen to other angels. These are not traditional demo days in the sense that there's like a huge audience, and right, these are like pretty intimate kind of 20-person Zoom rooms where the founders talk to the investors for 20 minutes and they can really go deep and have like a real investor meeting. So you're all cordially invited to our investor showcase. I will say that this series of events is only for VCs or angel investors that are accredited and serious about investing, right? We don't want to put these founders through like performative pitching. We really want them to like raise some capital. The showcase occurs the week of February 21st. All of these companies are already Graham & Walker portfolio companies, which means that we did a full due diligence process on each and every one of those companies and kind of discarded multiple companies in the process of doing that. And so we'd love to share a deal flow with you all. They're the right stage for angel investments. I know that they'll be happy. And we're going to put a link in the chat to the investor showcase. I think it's already there. And then for those of you who are not ready to write checks at this time, but you still want to learn about the companies, just kind of not ready to kind of go in, or maybe you're not accredited yet, you can join us at demo night, which is the more public version of that event. And I think Divya is going to put a link to demo night in the chat room as well. There we are. Okay, Elaine, back to you. Should we take some questions from the audience?
Yeah, that would be great. I'm going to stop sharing now. And yeah, let's open it up. And hopefully there's some things that you were able to take away that you didn't know before. And if there's things that are still kind of buzzing around in your head that would be good to get more clarification on, it would be great to share.
I can ask on behalf of Matt, who asked, what is your typical ask for advisory shares?
As in terms of percentage, usually we see advisory shares, for sure 2% or below on that, depending on how active and what the nature of what the advisor is bringing to the table.
I want to add to that. We also see it depends on what stage the company is at. So we see more normally between 0.25 and maybe 0.75. So like 2% is like almost founding team member level these days. And the
super
other
early, yeah, that would be
it's like super early, like
super
kind
early.
of first person off a deck. And then the other is that the expectation that that founders do vest those shares over a period of time. So you don't kind of get them up front, you get them over 1 to 2 years.
And thank you for that, Leslie and Elaine. Another question, how does one find angel funds that are focused in the area that you're interested in? So specifically, verticals of environment, energy, food. Are there any resources?
Great question. So one of the things, there are so many different kinds of angel groups out there. And so some angel groups don't have an area of focus or not a specific thesis, while others do. So here in Seattle, for instance, there is a group called Element 8, E8, and they are clearly focused on clean tech. And currently I'm in a specific early stage startup called, or early stage conference angel group that started on medical focus, right? So if you have a passion or expertise in a specific area, one of the best ways to do that is to look for an angel group that meets that. If that is exclusively kind of where you'd like your portfolio to go. So for me, I really have no background in medical. The reason I went into that group is I realized that in my portfolio, looking at my 20 companies, a number of those that were doing well had that bent, and I wanted to learn more about that. And so I am learning a huge amount from all of these fantastic angel investors that are much more knowledgeable about that space than I am. So it's great for me as a chance to learn, you know, a little bit more in that functional area.
And would you say, Elaine, that is it most beneficial to have to get an introduction or referral to join an angel group, or do you think sort of cold calling, cold emailing, does that work?
Oh, in terms of joining an angel group,
trying to get in.
Yeah, in terms of angel group, definitely you do not need a personal introduction to many of them. Some people do have qualifications, like just here last night there was an open forum of I think it was like 8 different angel groups talking about their different qualifications. Some had like background and experience, some have a price to join, some don't, right? So it's all over the map. So I would say the good thing is kind of like do a little homework on, visit their website, try and understand if you think it might be a fit for you. Some are totally online, and are not regionally bound. Some are only in a certain area. So there's so many out there. It's just great for you to kind of explore, but no, it doesn't need to have a personal connection. But if you do know angels, it's also great to ask them through what vehicles are they investing, so you can kind of understand a little bit more about the process.
And then there's another question in here about the benefits of investing at the angel stage, and whether the risk, do the benefits of investing at the angel stage outweigh the risk, or does that only depend on how many investments you make and the due diligence?
All of the above. So I would say within angel investing, you can decide how early a company is, or kind of where your own personal thesis is. But for me, being a data person, I think having a diversified portfolio is fundamental to being successful, because it is a risky space inherently, right? We do our best to kind of, in that due diligence process, cull through the opportunities and where we want to place our bets. But at the end of the day, nobody has a crystal ball, right? And that's why the diversification is super important, because I mean, I'll be totally honest, I've invested in companies that I thought, man, they were outstanding, and they're no longer around, 5 years later. And it's not because I wasn't attentive in the due diligence process then. It's just that, you kind of, maybe it's like an impressionistic painting. I see what they can become, but it's not super clear. And depending on how things unfold, all my bets didn't come out, right?
So this is actually a great segue to this next question. Tell us about, any exits or successes you've had. Is there something that you're super excited about in your portfolio that you want to talk about?
I am lucky to have had money come back already, and I still have many bets on the table. And I have to tell you, probably whatever is my most recent investment is the one I'm most excited about, because they all get me excited. And I'm very supportive of like having different industries in my portfolio, having, like I said, having an array of everything from strawberry picking robots to medical devices that take much longer to kind of come to fruition. So I don't want to single out any one, but each one gets me excited, honestly.
Wonderful. I think we have just about time for one more question. Actually, I'm going to go back to one about the advisory shares. With the advisory shares, is it normal to have a cliff with the vest?
So Leslie, if you want to say what you've been seeing.
There, it's not as common as with employee shares where you have like a 1-year cliff. Normally what I'm saying, because these advisory relationships are usually more like you meet once a month or once a quarter or something like that, then we're seeing we're seeing them vest either monthly or quarterly. And I don't know what's out there. I personally have never been put on like a year cliff. I think that like the most that I've gotten is like a once a quarter cliff. And
because
and
I would say supporting on that, right? I think you want, as an entrepreneur, you want your advisor to be really powerful and impactful out of the gates. So to incent them to be doing their role right out of the gate, I wouldn't think you would want them to have a 1-year cliff.
Wait all that long, yeah.
Yeah, just to be fair on both sides.
Exactly.
Wonderful.
There's a quick question here on can one become a board member of your investor evaluation? That's really uncommon to put an angel investor on a startup's board. Normally the company won't, I mean, unless maybe untraditional angel investments, but usually the first person to get on the board is going to be the lead VC, and there's not going to be any additional seats to that, which is not to say that like early angel investors might become independent board members later down the line. That's a possibility.
Yeah, usually, you know, who is your lead investor in your round kind of drives that.
Thank you so much, Elaine. Thank you so much, Leslie. We are right on time, so I want to be respectful to everybody's schedules. We will be sending an email with links and with the recording of the session, so you know you will all have time to look at this in detail. Thank you so much for attending, and hope you all are obviously on our newsletter. So keep watching the space. We will have a lot more events announced in February and March.
You bet. And I will also share the slides on SlideShare. So, because I know there was a lot of data, a lot of things going by quickly. And if you want to take one of those 2 or 3 nuggets away and just go back and look at that, you can always find it from my slides on SlideShare.
That's wonderful. Thank you so much, Elaine. Someone actually asked for that. Yeah, thank you.
You bet.
All right.
Thanks so much for coming.
Have a great day.
Great seeing you all.